Chapter 8. Financing Real Estate Deals. Rich people use debt to leverage investments and grow cash flows. Poor people use debt to buy things that make rich people richer. Grant Cardone. If you listen and follow Dave Ramsey, you probably break out in cold sweats when you hear the word debt. There is no lack of negative perceptions when it comes to talking about debt today. On the surface, he is right when he insists everyone should avoid bad debt or consumer debt like the plague. However, this is not the case for savvy real estate investors who use good debt to buy cash-flowing, appreciating assets. Good debt allows you to build long-term wealth by leveraging debt instead of paying 100% cash to purchase assets. There are a myriad of financing options when it comes to purchasing real estate. You have traditional lending for primary residence, commercial loans, seller financing, home equity lines of credit, HELOC, lines of credit, LOC, credit cards, hard money loans, private investor loans, individual retirement accounts, IRAs, and of course, cash. Creative financing. I recall one of my most memorable creative real estate financing deals to date. It was 2018, and we were displaced after Hurricane Michael devastated the Panama City area. I subsequently shifted my marketing 3 hours away to Mobile, Alabama, where my parents were living. I pulled an absentee owner list and started a postcard campaign looking for value-added properties to purchase. After only 1 month of marketing, I had a warm lead with an investor builder owner invested in having someone take over his monthly payments and management of the property since he was tired of being a landlord. The house was a 1,400 square foot starter home built in 2006, close to downtown, with a $39,000 mortgage balance, $380 mortgage payment, and $72,000 appraised value. I was able to craft a win-win solution by taking over the payments and management. I established a land trust to take ownership to avoid activating a due on sale clause with the mortgage company. In the end, I paid a whopping $1,453.69 closing cost to take ownership with the existing loan still in place. I have used every loan I listed above in my 10-plus year investing journey. To be successful in real estate, financing creativity is a must. Starting with limited capital, I leveraged debt to buy my first rental property. Upon purchasing my first flip in 2015 in Alexandria, Virginia, I leveraged a hard money loan, personal capital for my down payment, and my line of credit and credit cards for the renovation cost. Unfortunately, I didn't have a mentor, coach, a network of other investors in a mastermind, nor did I have experience leading a fix and flip project yet to obtain better terms. A hard money lender is a non-traditional lender that lends money based on the property used as collateral. Most times, the capital comes from either an individual, a private equity fund, or other group of investors. I met with multiple companies shopping my deal around before finding a local hard money lender who would lend to me. He wasn't cheap, and I cringe when I look back at the terms he charged me compared to better rates terms and the large amount of lenders available today. He gave me a 6-month term for $230,000, including a $40,000 renovation draw with a whopping $23,000 loan discount added at loan payoff. If I had to do it all over again, I would still do it because we learned so much from the project that we still take with us in every project we execute. Luckily, the lending landscape is a lot better now, and there are more opportunities to partner on deals to get started. After signing the term sheet for the loan product, it was a huge relief despite the terms, but the due diligence work began. Leading up to receiving the term sheet, I had to provide my financial statement and a list of recent projects, a schedule of real estate owned, and our estimated renovation budget. This hard money lender wasn't a large lender and was essentially a single individual with a high net worth. I met him at the property for his inspection, which is typical since the property secures the loan. The inspection went without a problem, and we were cleared to move forward with closing as we waited for the title work to be completed. Today, I work with a lender who started paying an individual inspector to take pictures and write a report before approving, but now they are comfortable with me just supplying pictures of the project for approval. They also perform desktop appraisals versus having a physical appraisal to assess the after-repair value. Now, let's talk about the capital required through the process and how renovation funds were released. Initially, once we went under contract, we wired $4,300 into the escrow account for closing. After shopping around for a loan and deciding to move forward with our lender, I had to pay a $1,000 loan commitment fee up front before closing. Most hard money lenders also charge organization points or fees based on the amount of the loan. My lender waived this fee. Most hard money lenders provide the option to pay for renovation costs and hold the money in an escrow account post-closing. My lender held back $40,000, which could be assessed in 2 draws of $20,000 as renovations progressed, along with a $250 draw fee for each draw. We had 30 days to close, which is somewhat standard, but depending on your real estate market, you may have to shorten your time to close to have a competitive offer when you are in a multiple offer situation. Lastly, at closing, we had to bring another $34,109, which represented the closing cost plus a 13% down payment. We moved on from our initial hard money experience and developed more relationships with larger, more established lenders. Your lender is an intricate part of your real estate team and provides you with the means to scale your investment portfolio or fix and flip business faster than only using your capital. Real estate is one of the few assets where you can purchase an asset with 80% leverage and receive tax depreciation on an asset that appreciates while it creates cash flow. Furthermore, the bank or lender doesn't participate in the upside appreciation of the asset, and you, as the owner, capture 100% of the asset's increase in value. Private notes. A perfect example of leveraging multiple funding options as an investor is my friend, Mr. Justin Melendez. I met Justin in one of my mastermind groups, and he is an active investor in the Fayetteville, North Carolina, and Augusta, Georgia markets. Justin shared how he funded one of the most recent flip projects he picked up from a local wholesaler. After walking the property, he went out to his car to contact the wholesaler. I sat in the parking lot and I texted him. I said, "Hey, I want it." And we locked it up right there. He sent me the contract within a few minutes and we locked it up. I recognized an opportunity, so I acted fast. But I didn't have all the money. There were a few reasons we didn't have the money. I had a $25,000 note that I lent to another friend who was doing a flip. It hadn't matured yet, but we were expecting it to mature within the next few weeks. With interest, it would be $27,000 when it came back. I had about $40,000 to my name, and in another transaction, we were selling one of our rentals, which was about another $22,000, closing a week before we would close on this new deal. But I wasn't comfortable with that, and I wanted to make sure we had the money as soon as possible so we could close on this and seize the opportunity. I reached out to my family, and luckily my brother was willing to partner with me, and he lent me $25,000, and my mom lent me $7,000. Justin provided two different investment options based on the amount of capital invested. If you invested $10,000 or less, the investor would receive a flat 10% return for 180 days, which is a great return. For $10,000 and above, investors can choose a 10% flat return or become an equity partner and possibly receive a larger return. His brother opted for the equity position and was given a 75%, 25% split. His mom invested $7,000 and received a flat 10% return. There were no interest payments throughout the term and no origination points. Once the project was completed, investors received their principal plus interest. For my business, Operation Invest LLC, I primarily provide a 10% annualized return with a 6-month term, since most of our projects take around 4 or 5 months to sell or refinance. My investors access our third-party secured investor portal website to see all our offerings and to digitally sign all the documentation. All funds are wired or sent via ACH to fund a deal, and when we pay out the principal and interest upon sale or refinance of the project, at the end of the year, investor tax documents can be downloaded from their account. Another great loan for investors is commercial loans. They are usually less restrictive than traditional mortgage loans as they allow for higher loan balances with no primary residence requirement. Additionally, there isn't any federally imposed limit on the number of active loans you can have. Since these loans are given to corporate entities, the loans never show up on your credit report. However, it's not all roses and unicorns. Most commercial loans require investors to have a higher credit score than traditional mortgages. Also, commercial loans require a 20 to 30% down payment with shorter terms and slightly higher interest rates. Local lender partnership. As we grew our rental portfolio in Panama City, Florida, one of our local credit unions became an intricate partner on our team. As we scaled up our investing business and began to work on simultaneous projects, capital became a premium. We started sharing more of our investing journey on social media to share with others that was possible through real estate. In return, we had a couple of family members approach us about investing with us on deals. We were able to work out great terms that were mutually beneficial. However, as we moved into buying houses, all cash and paying for renovations across 3 houses, we leveraged our credit lines to keep operations moving forward. Once I pivoted, keeping more homes as rentals, we ran into an issue with qualifying for a loan. This was due to my credit score reflecting a high debt to income ratio because of the credit line utilization. Through networking, I found a local lender that offered a commercial portfolio loan and could offer me a cash-out refinance for my 3 projects and the subject to property I picked up in Mobile, Alabama. We started the loan process in November 2019 by completing an application and sending over our rental leases for each property along with the scope of work for the renovations completed on each property. The terms weren't that great, with an interest rate of 8.375%, 5/1 adjustable rate mortgage, ARM, 65% loan to value, LTV, 25-year amortization, 15-year term. Even with the 3% prepayment penalty, It was worthwhile to refinance as soon as possible. We closed with the first lender, paid off our credit lines, waited 2 weeks for my credit score to update, and then began the refinance process with the credit union. We refinanced the loan before we made our first payment and secured a great partnership that continues today. Our apartment financing terms were similar: 4%, 80% LTV, 5/1 ARM, 25-year amortization, 15-year term. Going through our portfolio refinance, I learned a ton about how credit unions work. They keep all their loans in-house, as they don't package them up and sell them. The loan approvals are done by a board after the business development lead presents your loan package, which comprises your credit profile, schedule of real estate owned, and personal financial statement. When it came to the apartment, I completed my underwriting as I analyzed the property to determine my offer price. I shared my analysis with the business loan representative, and he gave me a piece of feedback that stuck with me. He told me that when he has investors come in looking for a new loan and provide their spreadsheets and internal underwriting assumptions, it gives him confidence in their overall capability to manage and execute the business plan for the property. We went under contract on our apartment on March 8th, 2020, a couple of weeks before the country would shut down due to COVID-19, which placed an enormous amount of stress on me to get the deal closed. As I listened to the other investors and podcasts, it was apparent the lending environment was starting to shift as the stock market began to tank and the economy began to come to a screeching halt. It took us 3.5 months to close, primarily due to us requiring the seller to repair a leaking water main before closing. Furthermore, the delay allowed us the opportunity to go from bringing all the required $210,000 for the 20% down payment to executing our first syndication. I first learned of the syndication model back in October 2019 at my first multifamily investor conference in Orlando, Florida. One of the speakers was a syndication attorney who had recently written a book that I purchased about the topic. Previously, I created promissory notes with a fixed rate return for some of our single-family projects where we had private investors. I took this same approach to raise private investor capital to bring to the apartment deal. As we moved into April and May, finding investors still looking to invest with all the uncertainty going on became a challenge, but I refused to give up. I received a great referral for a syndication attorney from a couple of investors in my newly joined mastermind group. A syndication attorney specializes in Securities Exchange Commission's (SEC) law and creates the necessary documents required to comply with SEC laws. These include the Private Placement Memorandum (PPM), Subscription Agreement (SA), and the operating agreement for the new entity that will take the title of the apartment. As I mentioned back in Chapter 5, I brought on an additional general partner, GP, Rory Compton, whom I met a couple of months earlier in my mastermind group. He helped raise $75,000 to go with an additional $20,000 I raised from a friend. We provided our investor partners a 7% cash-on-cash (COC) return, paid quarterly, 2-year term, with a $20,000 equity share at the refinance milestone, which gave them a 17% IRR for the 2 years. We eventually completed the water main work and closed the deal in June 2020 in the middle of a pandemic. Rich Dad Advice. One of the most well-known real estate investors and authors in the world is Robert Kiyosaki, author of Rich Dad Poor Dad. I recently listened to a Bigger Pockets podcast episode he guest appeared on to discuss real estate investing. The first property he ever purchased cash flowed $25 each month. Today, he owns 6,500 homes, and every one of them puts money in his pocket each month, and it all comes from debt. He shared his perspective on how a business's primary purpose should be acquire real estate for you to acquire massive amounts of debt, so you can legally avoid paying taxes. His rich dad told him that to be rich, he needed to understand real estate and entrepreneurship. His approach of leveraging debt allows him the opportunity not to pay any taxes. His approach came from Tom Wheelwright, who says taxes are used to incentivize capitalists to use debt. Real estate is so critical to America and capitalism because investors provide housing to millions of Americans. They don't teach real estate investing and financial literacy because the government needs uniformed people to pay taxes at the end of the day. The host, Brandon Turner, shared how he leverages real estate financing to buy properties to hand down to his kids. His strategy entails buying a property when each of his kid is young and placing a 15-year mortgage on the houses, so the asset is paid off by the time they are ready to go off to college. He reaps the tax benefits, the cash flow over the time frame, the tenant pays off the mortgage, and his kids can use the property to pay for college or start a business after graduating high school. One of the key themes Robert spoke about directly impacts mortgage interest rates, which is inflation. Leveraging debt to purchase real estate serves as a great hedge to inflation. One great metric to track inflation is the Consumer Price Index, CPI, the weighted average of the price of goods and services over time. In June 2021, the CPI jumped 5% for the 12 months ending in May 2021. This represented the largest annual increase since August 2008. As inflation rises, so does the cost of everyday household items we use daily, as well as the price of real estate. When interest rates are low, real estate becomes a great hedge against inflation due to the increased value and payments over time with dollars that have less buying power. Unfortunately, every time the Federal Reserve prints money, they screw over working-class people who lose buying power because of inflation. Fortunately for investors, the price of real estate increases with inflation and the price of rent. As your rents increase, your cash flow will increase, which provides additional capital to use at your discretion to invest or pay down your principal sooner. To take advantage of the low interest rate and high inflation environment, Robert discussed refinancing his properties and pulling out millions of dollars to buy more assets. At the moment, he was obtaining rates as less than 2%, which had minimal impact on his overall cash flow from his portfolio. In the first quarter of 2021, investors bought one of every 7 U.S. homes purchased. This represented a considerable increase based on the previous 3 quarters when the metric was only 1 out of every 10 homes. Additionally, Lennar Homes, one of the largest home builders in the United States, announced early in 2021 that it was purchasing over $4 billion of new single-family homes and townhomes in high-growth areas to rent them. This clearly highlights the approach of investors hedging against inflation while loan rates are low. Self-directed retirement accounts. Another great way to finance real estate deals is by leveraging self-directed retirement accounts, SDRA. Whether leveraging your account or those of other investors, SDRAs give you the ability to diversify a portfolio and secure above-average returns. Author James Misko calls SDRAs the best-kept secret in real estate. You don't have to only invest in the stock market and cash deposits, CDs. Self-directed IRAs allow you to invest your own money into assets you are knowledgeable about, The largest concentration of investable cash for Americans is their retirement account. A person with investment capital is more likely to have more money in their retirement account than their personal savings account. A self-directed retirement plan can lend money to another investor with a deal, and that investor pays back the IRA or 401k plan under the promissory note terms. The retirement account is the lender of the promissory note, and the other investor is the borrower. The promissory note can be structured with monthly payments or a lump sum at the end of the agreed term. Additionally, your retirement account can receive points and interest from the lender. Your SDRA can buy real estate too. After identifying a property for purchase, the contract to purchase the property is in the name of the SDRA, and not you as the SDRA owner. Once you close on the property and start to collect rent, the expenses for the property are paid by SDRA, while income from property such as rent or appreciation from the future sale goes directly to SDRA. These are just a couple of the numerous SDRA strategies that allow you to control your investment capital better. I have current investors who partner with us on deals who leverage their self-directed IRAs to passively invest in our deals. They sign up on our investor portal and create an investment account for their SDRA. When they see an offering they would like to invest in, they simply sign the promissory note electronically as the manager of the SDRA and wire the money from the SDRA checking account. Once the project is complete, we wire the principal and interest back to the SDRA's checking account. If you have an old 401k or IRA from a previous employer, I encourage you to find more information about rolling it over into your SDRA. I am not a CPA or attorney, so please seek professional advice to assess the best strategy for your situation. Implementation. Hopefully, after reading these stories and examples, you have some new ideas on leveraging debt to take your investing to the next level. As a real estate investor, one skill we didn't discuss in detail was the process of how to raise private money and the proper way to do it. Ultimately, as you grow as an investor and become more experienced, your ability to receive financing and raise private capital will increase. There is no more humbling feeling than to have someone give you their hard-earned money to invest in your ability to execute a real estate project. When it comes to traditional financing, your credit score is extremely important along with your debt-to-income ratio. What's your current credit score and debt-to-income ratio? Do you have a good relationship with a local bank or credit union? If not, I encourage you to go and sit down with one of their business development representatives and learn more about their commercial products. This will be an invaluable relationship to assist you in building a rental portfolio and long-term generational wealth. I spoke briefly about the power of leveraging a self-directed IRA to grow your retirement accounts outside the roller coaster ride of the stock market. In the next chapter, we will dive into single-family home investing.